Welcome to China Focus. I'm Shelley Zhang. Last week, Fitch, one of the three big credit rating agencies, downgraded China's long-term local currency debt from AA- to A+. Now, Fitch cited three things they were worried about in China's economy: structural weaknesses within the economy, too much easy credit, and an opaque shadow banking system. Here today to talk about Fitch's downgrade as part of our ongoing series on China's debt problem, Chen Zhifei and Jason Ma. So what does it mean that Fitch downgraded?
It's actually a big event because so far, although there have been a lot of speculation about China's debt problem, as illustrated in our previous episodes and widespread commentary on this issue, there have been muted response in official credit rating agencies like Moody's and Standard & Poor's. So on the surface, it's still very calm. However, this event that Fitch downgraded really encapsulated this kind of nervousness. They also disclosed at the same time the amount of bad debt that could go the other way for China's banking system, which could even in turn cause more havoc to the economy. Now, for the first time, we knew that debt could total up to 198% of GDP, translated into 100 roughly trillion yuan, which is a gargantuan amount.
So how does that compare to the official numbers we get from the Chinese government?
The official number about the Chinese government debt or local debt is a national secret. So I have no idea. There are different numbers kind of throwing around, and generally speaking, people were thinking about the kind of 10 trillion is a number, but at this time you talk about 100 trillion. So that's a huge gap with.
Well, there's some clarification that's probably in order here. The debt we're talking about is the total debts, including both public and private, that have taken on by the China state banks. So 10 trillion is the debt owed by the central government. Then another 30% of GDP, or you can say 20 trillion, is owned by local governments, which eventually could be taken over by central government. So there was like 40 trillion yuan that is owed by the central government. The rest of the debt was owed by the banks to the private sector.
Yeah, but I have to kind of emphasize that all these numbers are some kind of people just derived from different channels. There's no way for you to clearly get it.
So it's an estimate.
It's estimate. I mean, even worse than estimated, because clearly Chinese government prohibited Chinese local government to directly borrow money. They have to use some vehicle, like a finance vehicle. Almost every level of Chinese government have their financial vehicle company. They use that company to borrow money. Sometimes the company is a joint venture with private. So basically, it's a very mixed picture, and you even don't know whether some money owned by the local government or by some kind of private.
I think that's where the value of this new estimates put out by Fitch come into play. It really gives us a ballpark number or some kind of measure to encapsulate the kind of the state of the affairs in the Chinese banking sector. Because previously, when we were doing our program, I quoted China's prominent economist estimate, Wu Jinlian. He put a number at 60% of GDP, which is far cry from 198 or 200%. So this is really a shocking news to a lot of people, and consistent with a lot of people's conception and confirming a lot of people's anticipation that something bad is going on in China's banking system.
Well, let me ask about one of the things that Fitch brought up, which is this idea of this shadow banking system going on. It sounds kind of mysterious. What does it mean, shadow banking?
It's just kind of some loan process beyond the normal official banking system. We know Chinese kind of a bank, most of them owned by the Chinese government. They don't really want to carry a lot of the risk business. And so they are very strict about who they give loans. Like they only give some local government or state-run enterprises. For some smaller businessmen, I mean, they have really difficult to get money from the normal banking system. But meanwhile, Chinese save a lot of kind of money in their saving account. So what is happening is those kind of medium, small kind of business, they build some kind of institute. They kind of directly borrow money from the savers. But of course, the bank the official bank is the middleman here. And basically, for example, I know my friend, he right now is buying something he called a personal finance product, which is indeed is something middled by a bank, but really kind of he have to put like 1 million renminbi of his personal saving in an account. Every year they promise give him 10% of a return.
That's a huge return.
He said that's not. He said that's
Really?
not. I mean, he said
what Jason described exactly the cause of so much of that in the West, because it's almost like what you described, a replay of the housing bubble in the United States. I think what I found out about its banking system came about only in the last 2 or 3 years. When the government started tightening up the spigot of the money flow into the banking because they put out restrictions. So bank could not easily lend out money to local government for real estate project. So they said, okay, now let me, that you described, serve as a bridge between the depositors who are crying out for higher return because return is so paltry, and those people at the local government who still want to build their showpiece projects. So they developed this kind of derivative product, investment vehicle, officially known as wealth management products. So they take money deposit from the investors into the pockets of local developers who usually are government officials. So banks are the middlemen. They are earning the spread, but the promised return are unexpectedly high. The yield is very high, like 10%, 12%. So eventually this
10% is the low end.
The game runs
Low
like
end for these, but
right.
10% is like super high for
impossible,
3%
not sustainable.
return.
So this is the reason it's constantly considered. I mean, it's a risky business. I mean, indeed, sometimes my friends told me he didn't choose those 30% of return product because he thinks that's risky. So he chose the safer 10%. I said 10% is risky enough. It's just because right now China, every part of China is grow fast, especially those real estate market. So they kind of the housing market is increased as crazy. So they can sustain this 10% for the past 3 years, but so more and more people begin to put money in it. Gradually, it's probably transfer from an investment vehicle to a Ponzi scheme kind of situation. I mean, basically, it's this now that will transfer some money from investment to a Ponzi scheme. At that moment, if there is a huge scale of Ponzi scheme kind of thing.
I think you probably are obligated to tell your story, your friend's story of Madoff. You know, really, beware of it. The timing might be coming soon. The timing might come soon that
but
you have to.
Well, let me ask,
if
the bank is acting as the middleman in this, kind of transaction, is this regulated by the banking industry in China?
No, it's not. It's actually, that's why it's called shadow banking. It's even called off-balance sheet financing. So those debts will not appear as debts in the companies, in the bank's financial books. In accounting, it's not even assets or debts to them, even though the banks are middlemen selling and buying assets.
Right.
So they are like derivative products in the United States a couple of years ago. Nobody would be able to see it. That's why I found it very encouraging that Fitch somehow gave us some estimate about how large the size of this hidden assets and debt.
Right. So if that 10%, every year 10%, 30%, that becomes unsustainable, what is going to happen? Right.
I guess definitely you will see this is happening all the time in China. I mean, sometimes a local group of people kind of stock a company because the company cannot kind of keep their promise to return of the money they own. And so in the future, this kind of thing will be more and more. And of course, I mean, because of the Chinese economy are still kind of growing very fast, and also because Chinese financial system is still isolated in that country. So financially, I don't think this will affect in the world global financial system as the U.S. banking system did in 2008. But this, if something happened like this happened, a crash in China, the GDP over there will just kind of probably reduce to zero, and then all the global kind of construction materials like Australian, Brazil, all these kind of country depends on this export of these raw materials will be hit very hard. And of course, the U.S. export to China will also be hit. That's definitely have a very significant kind of impact to the world. Anyway, China is the second largest economy in the world.
Yeah. So, I mean, it seemed like when Fitch came out with this downgrade. It was reported widely in the media, but it seemed like the market didn't really react to it.
Because the market had already sensed it. It's already impounded in the stock price. People widely anticipated. However, Fitch was the first to come forward, step up to the plate and give us some estimate. And the size of the shadow banking is huge, unexpectedly. I thought it would be only in the amount of $10 trillion. We look at the report, half of the private debt, that amounts to 30 trillion would be private sector banking debt, which is uncontrolled by the government. So this is really like a time bomb that could have a lot of power working like a weapon of mass destruction.
So let me ask, like, if this kind of bomb goes off, who is going to be left kind of holding the bill? Like,
my friend, the people like my friend. So basically, he do have 1 million of his personal saving in this kind of vehicle. But generally speaking, it's kind of all the people who right now invest in China may have some kind of issue, because right now China did print a lot of money. This kind of talking about every year the amount of money they put in the market is like 135% of their GDP, and they accumulate so much money over there, and that potentially can really, in the long term, reduce the Chinese currency value. And so a lot of the people invest in China right now is facing this kind of risk.
Yeah, the significance of this downgrade is manifold, not just about the downgrade itself, but also the data set and some kind of intermediate result shared with the public that put Chinese economy into perspective. For instance, Fitch shared with the public a chart that shows the GDP growth and bank lending growth over the 10 years in China in a bar chart format, side by side. As we can see on the screen, in each of the last 10 years, the growth in lending and credit always exceeded that of GDP. Even GDP growth has already been remarkable. And that in economic terms is a taboo. That means the credit is too easy, and eventually somebody have to either foot the bill or the system, as happened in the United States and the West, would collapse.
Right, I guess basically, I think Chinese government will make sure Chinese people pay the bill.
Well, I was going to ask if the government was going to step in here.
I mean, basically, all the solution is the printing more money and the inflation, using inflation to solve the problem. I mean, it's already happening. I mean, in China, in the kind of later this year and early this year, late last year, the real estate market under very restricted kind of rule, still kind of growing like crazy. So it's just a reflection of the easy money is floating everywhere, really boost the kind of housing market over there.
Yeah, I think that's also dangerous. And another very prominent issue that emerge from this is this time may be different because shadow banking. Because the shadow banking works like a pawn scheme. So some people will be really hurt. Some people will lose their shirt. So that's why I said you have the obligation to call your friend, said probably it's time to sell because if you're late, you're late.
No, I guess.
What should people be watching for?
It's just like go back to my friend. I mean, I told him, but he said, I don't think so. So it's always like this. When you are making money, when you are seeing Chinese GDP is growing like 10%, 8% at least every year, and you just don't believe anything bad will happen soon. You think you are the person who will jump kind of out of the boat before it sink, but a lot of time it kind of just sink with you.
Well, as a rule of thumb, I would advise people to heed this advice that when things get too good to be true, avoid it.
Seems prudent. All right, thank you both for joining us today to talk about this issue, and thanks for watching. We'd love to hear what you think. You can email us at the screen on the email address below, or leave us a YouTube comment. Thanks for watching.